All right, good morning, everybody. It is just after 6:30 a.m. on Wall Street, 3 hours before the stock market opens. It's time to get your macro on. Welcome to QuantBox Live, where we uncover the best fundamental investment opportunities across global markets. My name is Wayne McDonald. I am a trend trader since I don't know, 2002 ish, something like that. Anyways, right? Or I guess this says 2004. I'm also a classically trained economist at a little private school in Cambridge, Massachusetts. I love trade. I love trading. I love trend trading. I love technical analysis, but the basis of my decision making is always fundamental. Macroeconomics is the flow of capital around the world, and there's always a reason and rationale for why money moves. It's not random. There's a reason and rationale for this movement. And from that, I go into the markets looking for technical opportunities in the direction of that capital flow. So, to get that information, you need macroeconomic data, and in particular, be able to compare them amongst asset classes like how's Australia doing versus the United Kingdom? What's the monetary policy in the United Kingdom versus Australia or New Zealand or Canada or the United States or Japan? Does it matter? Yes. And then we can scorecard these things like here's interest rates between all those different economies. And the higher ones tend to attract money, and the lower ones, well, people borrow them because they're cheap. So, anyways, there's a rationale for all of this. There's a reason for all of this. And that should be the basis of your trading. And if you know why you're making an investment and you know things like maybe like why it's going long, but you also know things like technical analysis and more obscure things like seasonality, maybe you'll have the confidence to let your winners run. That's the whole point of QuantBox is giving you the confidence to let your winners run. It'll radically change the way you trade, not marginally improve it, but radically change how you trade. So, anyways, you can try it all out. Lots of pretty colors, should make you smile, make you happy. Take a test drive. It's only $8. QuantBox.co. And for those who are watching this on YouTube, you're watching it delayed. You should be here now. You should be here live. The video gets posted inside a QuantBox around 7 a.m. So you're watching it many hours late if you're watching it on YouTube. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Oh, I have to do a hard login. Am I in the right browser session? Oh, well, we'll find out. Let's see. Yep. Don't. They still didn't fix that. So right now, I want you to be aware that there is a bug. We did an upgrade, and the developer said, no, they fixed everything. And I'm like, dude, I just logged in, and the first thing I looked at is this is still broken. Oh, really? Dude. Anyways, yeah, it's funny. They fixed all the stuff I probably didn't see broken, but um, just notice that this bias isn't working. I think it's working on the scorecard summary, but nonetheless, this is neutral, neutral, but they're not neutral. Look at the score. Look at the score. -4 is not neutral. +9 is not neutral. Anyways, anywho, make sure you're aware of that. Right now, the markets are very mixed. Bitcoin up 0.37, still below 30,000. That's the news. That's the news to use. Below 30,000. Euro dollar flat at basically farting around 110. Okay. So think about this. Bitcoin just farting around a psych level, euro dollar farting around a psych level. Doesn't matter. Well, for crypto, Bitcoin's huge. For euro dollar, for currencies, right? Euro dollar is huge. And what does this tell us? The two largest assets haven't done anything. Okay. Wow. So S&P 500, is this right? Or is that a bug? Is it really up 1% already today? Is it? I guess so. Hmm. I didn't know futures had moved that much already. So that's interesting. Maybe in the last hour, it moved quite a bit. So, anyways, up 1%. I know mentally, because I'm mental, I know mentally there's a giant, big, fat pivot point right there, right about 4,600, which means if I was going to take profit, I would really be thinking about it because I think it's double topping. I'm not looking at the technicals, I'm just doing it from here. Um, that's a big double top. Not that it means anything, it'll mean something if people start taking profit. So we need to keep that in mind. And up a big Monday, c- I've seen before a big Monday, a big Tuesday often lead to a down Wednesday, down Thursday, down Friday because we hit targets, right? So, anyways, we got to keep an eye on that. That's August highs, August projected highs. Oh no, sorry, July projected highs, and now we're rolling into August. Gold is flat. Okay, oil. Look at that. Wow, I missed that. Oil way up. Remember, our target was 80 back when it was 70 something. And well, once you hit target, what happens next? I don't know. If we hit the target, I don't know. Now you figure it out from there. And it's still going up. It took a lot. Remember, we almost hit 80 and then it dropped. Then we almost hit 80, then it dropped. And then boom, it hit 80 and now 81. So we'll have to take a look at that. If not today on this live stream, but maybe later today on the other live stream. Forex.today. Yeah, could be over there. And the yield on the 10-year T note. Yeah, check that out. It'll get very interesting when we get above 4. What we've seen in the recent past is when the yield on the 10-year T note gets around 4% or higher, people want to lock that profit in and they buy it because it's 4. Imagine you thought in 10 years inflation was going to be back at 2% like the Fed does, and you're already locked in earning 4% every year, no matter what happens. For a lot of people, that's a good use of your money. So, like you say, well, why would I want 4% if I can buy what is it, the 3 month pays 5? Well, the question is, do you think 5 years from now it'll pay 5? No. And will it matter if you own something 5 years? If you bought a 6 month treasury right now or a 1 year treasury, it won't last more than a year. So if the price adjusted up or down, you don't really care. You're going to hold it to maturity. But there might be a benefit for holding these things uh, for 10 years. Another way of looking at it. So you're like, but Wayne, if inflation drops back down to 2% and your 10-year T note is paying 4%, you're like, it's not a big deal. Well, first of all, you're earning double inflation. Is 100% more a lot? Yeah, you're like, yeah, it's only 2%. Yeah, oh no, it's 100% difference. But also, what would the value of your bond pay or be worth? Think of it as an asset now. It pays twice the cash flow as a new asset. It's like your apartment building charges twice the rent than current rent, and people are paying it. Your apartment building is worth a lot. Why? Well, instead of $100 a square foot, everyone in the building's paying $200 a square foot, and they're happy to do it. Your apartment building's worth more. We don't even have to argue the quality of the paint and the landscaping. And no, people are paying double per square foot. It's worth a lot more. So in the bond market, your bond, your treasury, your 10-year T note will be worth minimum the present value of the future cash flow. So if there's still 6 years left at 4%, right? You can do a discounted cash flow and come up with a number, but people might just want it and pay even more than that. So the value of your asset goes up. Why? Because yours pays 4% a year, and new treasuries 4 years from now might only pay two and a quarter, two and a half for a 10-year T note. So your 10-year T note will go up in value. Okay. Because it's paid twice as much. Okay. So, anyways, you got to keep an eye on that. People will start gobbling this up with that idea in mind, that rationale. So, if you're not a bond trader, that's the thought process for many bond traders. They are thinking the value of this asset over the next 10 years. And if they need to sell it 5 years from now and get rid of it early for whatever reason they want the cash, they'll be able to sell it for more than they paid for it. There's a way out for that. And that might be a good investment for some. Okay. Cool. Nothing's changed here. A little bit of risk off. Okay. That's creeping in. Remember, this is what we expect this time of year. And you're like, but Wayne, it's been flat, 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 flat for 2 weeks. Yeah, but remember the 2 weeks before that? Up, 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 on, risk on, risk on. And I'm like, but this is the time of year when that often fades. So when we went from risk on, risk on, risk on to mix, mix, mixed to now slightly turning risk off. Kind of interesting. That's what's supposed to be happening. It's not happening in any dramatic fashion, but for those who were along and making money hand over fist and felt like everything was right as rain, what could happen is people start to get worried. Right? Especially those that have bought the S&P 500 at the top, and now they're like, "Hey, my neighbor bought S&P 500, and right? He's up 30%." So now you buy it late, what happens? It doesn't go up at all. And then people get nervous, right? You're not supposed to buy it late. Dennis Gartman, he's a famous economist slash investor that used to write something called the Gartman letter. People used to pay a lot of money for it. Now he just manages an endowment. I think the University of Akron. Is that right? Anyways, he said he's shocked at the rally in the stock market that we've had this year. Flabbergasted. He said he was even wrong. There's no way it should be at this price. And he's like, and that with that being said, there's no way he can buy it now at these prices. What does an amateur do? Buy it because it's up. That's not what professionals do, right? No, but maybe Dennis Gartman sits on the sideline for 2 years. Well, you can't wait 2 years, but nonetheless, you should heed caution. I would say, thinking the way that institutional investors think, like, maybe next quarter if there's a pullback. That's a whole different thought process than buy it because there's a green candle. Speaking about that logic, we should probably look at the yens today, but we'll get there. Okay, you should have done your homework already. Remember, we have this. You should go through and you could look at absolute, okay, absolute longs and absolute shorts, okay, to find out biggest positions. And it's just showing you this data up here. But you also want to look at like where did the money flow to? Eight, we'll call it 9,000 new contracts long the Canadian dollar. Good job, Canada. Okay, cool. And then you can organize this the other way. Well, let's do it this way. For short, more, right? check this out. Gold, 15,500 contracts that were long or no longer long, and 4,000 new contracts short. So some of the bulls became bears. Okay. It's still heavily long, but it's interesting that the flow went the other way this week. Okay. Not freak out time, but it is happening. Okay. When we look at that CAD now, again, 9,000 contracts went long, 4,000 contracts went short, but still 2/3. Yeah. Is that right, math? 2/3 long versus, well, anyways, more long than short. So you can kind of look at this and try to look at changes in positioning, give you a sense of where the money is going. Look at pound. Net, nothing happened, but a lot of contracts changed hands, huh? But also notice that people are getting out of pound in general. They're not long, they're not short, they're not interested. So if you're going to corner the market on the British pound this week, it's either a really good idea or a really bad idea. Either a lot will happen, I guess, or nothing will happen. People are walking away from the pound, but they're still heavily long. All right. So you want to look at some of the same thing with euro. People are getting out of euro. Notice that this time of year, I told you be prepared for people removing money out of the market, lower volume, lower volatility. There's a, right? People getting out of dollar trades, people getting out of South African trades. Okay. People getting out of oil. 8,000 less, 9,000 contracts less long, and 28,000 less contracts short. Now that has probably already pushed oil up, but nonetheless, it's a thinner market. You notice that? So maybe down the road, maybe in 6 weeks, it'll still be going up, but significantly less participants. So if suddenly the market went short, it would come down fast. Okay. So, anyways, just kind of pay attention to that. I think that's interesting. Okay. A lot of shorts coming out of the S&P 500. A lot of people changed their mind. They were like Dennis Gartman said, "Oh my God, we had no idea that if anything they would short the S&P 500." Well, seasonally that would be the right thing to do in July. Maybe it happens in August, maybe it doesn't happen at all. The worst case scenario is it comes down in October. That'd be terrible. I think if that happens, I think like if the stock market drops in August, it's okay. It's a pullback. And you get better buying opportunities later in the year. That's perfectly normal, warranted, even wanted. A nice little summer fade. If it doesn't fade and then we roll into October and drop, everybody loses money. And that's not cool. But maybe that's what's needed to get inflation down. Who knows? I want to point this out, this asset to you. I want to point this out. I don't know if you're doing your homework over the weekend as you should be, but this is a good way to visualize what's going on in the world. Okay. If this data is a little blah because it's hard to read a table, this is euro dollar. Green is euro, red is dollar. We're only looking at the bullish positions. And there's a slight increase in bullishness in euro and a lot less bulls on dollar. Look at that, just in the last few weeks. It's pretty, right? Remember Canada Day? Yeah. Look how dramatic it was. Right on Canada Day. In particular, Canada Day, we said this is where you should be prepared for a change in what was happening. And whoo, people. right? Got out a dollar anyways. And here's another way to look at it. Okay. Up means bullish bias for euro dollar. Isn't that cool? So the red line is euro dollar. The bars are the direction of your bullishness, or your the direction of your bias. Bull, 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 bear, 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 bull, bull, bull. How do we get this data? Right here. Cool. Then you said, yeah, BOJ did a bond purchase. Yeah. Yeah. Well, remember, people were freaking out about the change in yield curve control, and I'm like, I can't get any solid data on what they've actually announced. And so I think something was said, something was said, but like, so there was a big reaction to the market, like, oh my God, it's all over. And yet nothing actually seems to have happened. And now the BOJ did a surprise overnight, as they say, purchase. But isn't that what they were doing in yield curve control anyways? And they didn't give us like good guidance of when they would buy the JGBs again. They just said, maybe more flexible, but they didn't say a number or anything. So, um, yeah, maybe we've overreacted, right, Denise? And so now they're just doing what they would have done anyways. They just told us it's not necessarily exactly point 0.5, it could be 0.55. People are like, what if it goes to 2%? Like, whoa, whoa, settle down. Right. So, anyways, what do we know about the Bank of Japan? Interest rates are negative. They want inflation. And all they said is maybe zero point 0.5 isn't necessarily the hard line on the 10-year Japanese government bond. Maybe it's something different. Well, that's not a massive change, right? We saw yield curve control adjustments over the last several years, and I'd have to look at the numbers again, but it was really weird, like 0.23, and then they jacked it up all the way to like 0.41, and then they jacked it up again to zero point 0.5. So, you know, thinking that the number is around between 0.58 and 0.62, you know, are the numbers now. But anyways, so there might have been an overreaction. Nonetheless, this isn't typically the right time to sell yen. I mean, let's pull one. Let's pull a euro yen because we have this data. You guys have such amazing, powerful data. See, the yen's come down in July and August. That's just factual. Okay. Now, are they coming down now? Well, it's been an up and a down period. July was sort of down and then up and then down. Lots of volatility in that because we do have something unusual happening with yield curve control and post COVID and all that kind of stuff. Um, it's an unusual year, but every year is unusual. But yet this is unique. What do we know to be factual so that we can compare and contrast our current situation with what we call a normal situation, even though every year is abnormal. Um, Over the last 5 years and over the last 20 years, you're not buying yen pairs now. Okay. But somewhere, right? August, Prince of Low, and then September, October, November. Look at this is COVID, by the way. Oh, it was so bad. What was it, 2 years ago? I can't remember when it was. I just remember the pain. That one year when it collapsed in October, and it's not supposed to collapse in October. and a lot of people got run over. And usually you're looking for the end of the year on yens to really be the best, and it really pays for everything. It's sort of like when that collapses, it kills your whole entire year. And you're like, oh my God, I have to buy a used Ferrari this year. What a terrible year, right? So yeah, it sucks to be a hedge fund manager, right? A used Ferrari? It was a bad year. Anyways, I look at this and I think I have, well, by the way, if you've known me for years, you know I think the third week of August to the third week of September, I'm gonna buy all these things, which means I'm not necessarily a buyer now. Very often I'm on vacation. This year I'm doing not a vacation, I'm doing research. Don't call it a vacation. That would be illegal. I'm doing research in Cuba in 2 weeks, so you'll have to trade a couple of days without me. Yeah, so I'll be very busy doing research and then scrambling to get back the third week of August. So I actually plan on this kind of stuff. So I'll be landing Monday night of the third week of August. I'm pissed, but it had to be done. So I'll miss that Monday, but I will be like at my charts Monday at midnight or whatever, straight back from the airport. Third week of August. Third week of August. Third week of August. Why does it matter to me? Long, 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 and usually to the end of the year. Okay. So yeah. So if it looks like a mixed bag right now, because it is a mixed bag. Okay. So look at this big drop and then a big move. Yeah, whatever. Isn't it wild that you average everything out? You're like, we were at 154, then we're at 158, and then we're at 152. Now we're at 156.63, which is the average price of the whole period. Right? So if you're a day trader, you got run over by a freight train. If you're a long-term institutional investor, you're like, what, something happened? What, did I miss it? Oh, yield curve control. Yeah. And nothing happened. Okay. So if you're positioned right, it didn't hurt at all. If you But all your newer trades might have gotten wiped out. Man, that happens. Okay. So, anyways, just a kind of an interesting way to look at it. We have an interest rate decision out of Australia this week. We have a lot of data. The Chinese data, did you trade that? So if you're in the investor boot camp day trading group, we talked about China news coming out last night. And I said bad news would be good news. And sure enough, the Asian stock markets rallied last night because of the bad news out of China. I'm like, I'm so glad we talk about these things. Okay. So we might be able to learn a little bit about what's going on in Australia. Okay. Right now, QuantBox, when you average a bunch of different things out, have an interest rate in Australia at 4.07. Okay. 4.07, 4.07, 4.07, 4.07. Wait, that's the middle of next year. So do you think people are going to be shocked to find out that Australia doesn't raise interest rates? Yeah. You're like, well, Australia, based on what we know now, will cut interest rates in the third quarter of next year. So 1 year from now. 1, two, three, 4 meetings of pause. Cool. Well, you heard it from me first. Actually, it's not true. This is what the RBA has already told us. The thing is, nobody knows because nobody listens. They'd rather guess and gamble than actually do the work. So QuantBox helps you do the work where you don't you don't get surprised. The surprise would be the Reserve Bank of Australia changes what they've already told us. So if there's massive stimulus out of China, then Australia next year is less likely to go into recession and more likely to be hurt by inflation. See, what's happening is their inflation is high and consumer spending, consumer confidence, that kind of stuff is starting to fall. That smells like recession because then later it hits GDP. GDP is late. You can't have falling GDP with consumer spending going up. So once you take away gasoline and food, there's no money left in Australia to buy a new Barbie. Okay. But I want a new Barbie. Not this year. Okay. Or no money to see the Barbie movie. You're welcome. So, anyways, uh, so look, if the bad news goes away, and you're like, okay, well, we have high prices, but people have the money and they feel confident to spend and they spend anyways. And that seems to be what's happening in the United States. Then this changes to the upside and we revise our opinion. But I wouldn't do it or I don't do it until I get the facts. Okay. So, what's your China play? If there's stimulus, money that flows out of Australia might flow back into Australia. Australia needs to sell some iron ore and coal. Okay. And if that happens, prices are high, consumers spend. In the United States, okay, prices are high, but people are still spending. Apple Computers is going to report this week, I believe. I think what we're going to learn based on my quick research of the world is that they're still making money selling iPhones. The issue is they're selling less iPhones, but they're selling less iPhones at higher prices. Okay. And then if we track this back, if people are buying their iPhones on their credit card, but they ain't got no money, then at some point that party's over. Because when you think about it, a rational person will say, my iPhone with 14 cameras is pretty good. I don't need to spend $1,500 on an iPhone with 22 cameras. I'll defer that purchase down the road. I will keep my phone. And instead of replacing your phone every 18 months, maybe you replace your phone every 24 months. Okay. And that changes things, doesn't it? Remember, economics is the study of scarcity. And so you have to decide what's more scarce, your phone. Look, if you smash your phone, like actually wreck it, you need a new phone. If you crack your screen, shoot, have you tried some of the new services? You go in, you give them the phone, and no joke, 17 minutes later, you got a brand new screen on your phone. You're like, damn, it's just brand new now. Have you ever used those services yet? My daughter and I went into one of those shops. She broke her iPhone screen about 15 times to the point where it was actually shards of glass. It was so dangerous, right? You could use it as a weapon in prison, right? You could scrape people with this broken iPhone. We went in and it was less than 17 minutes. Boom. She's got it felt to her like a brand new phone. So the point is, if money is your scarce resource is money, then you find a way and you defer the new phone, you see? And if money is the scarcity of for America, then you don't upgrade. You fix, right? Kind of like in Cuba. They're right? Nobody buys a new car. You fix the old car. The new cars in Cuba, they're 1980s Russian cars. Or you look at the classic cars, you're like, wait, is that a truck suspension on a 1958 Cadillac? It's like lifted off the ground like a 4x4. And then you start driving down the roads. Oh, I get it. But you'll have Ford parts on a Chevy car. Hey, man, whatever works, duct tape it, get it going. Right. So, anyways, what's their scarcity? They don't have parts and they don't have money. So they fix it. So if America runs out of money, they don't buy new phones, right? And so that you want to look at it that way, and then that's what leads to recession. So we don't have that yet, but Australia is starting to see that where consumer spending is starting to fall and prices are high. In the United States, it seems prices are high, but people are spending. Where are they getting this money then? They either have epically awesome jobs, or they still have stimulus money, or that's credit. Okay. And credit for a phone is really dumb. Oh, but it's okay. It's only $37 extra a month on my phone bill. Dumb. Okay. Yeah. Terrible idea. So, but that's how most people do it, I think, huh? Oh, Wayne, it's not $2,000. It's 30. You see, when you sign up for these things, you're like, it's an 8-year contract, but you, right? But you're like, but your phone's only going to last 18 months at most. But you signed up for like I don't know if it's really 8, but let's say, but you signed up $37 a month for 3 years. I don't know what the number is, right? Maybe it's 67. I don't do these things, but people are paying a lot of money for these phones and they're signing up for 3-year payments at high interest rates because they're not doing the calculations for a phone that they don't expect to have 3 years from now. It's like insanity. Like, what does that all of that mean? Well, Americans and probably most people in the world don't have any financial education, but also they can't afford it, right? If you ask how much the phone costs, you can't afford it. It's the same as a yacht now, huh? How much is that yacht? Too much for you, bro? Yeah, we got a boat over there. Go look at the boats. Don't look at the yachts, right? Yeah. All right. So yeah, that's that. I just wanted to show you the yens quickly, and then we'll call it a day. Am I on them? No, I'm on Aussie. And I just want to show you that undue volatility of people freaking out. Let's pick one, anyone. Yeah, Euro. There's a big collapse. Okay. And not long ago, not well, this is yield curve control. Like, oh my God, they're killing yield curve control. And then the yield on the 10-year T note went from zero point 0.5 to 0.55. And people are like, wait, the sky didn't fall. So it rebounded back quite quickly. Okay. And guess what they did last night here, yield curve control. Oh my God. So, anyways, freight train on that one. Okay. Happens though. It happens. If we look at the bigger time frame, okay, all it did was drop. You see this low area here? All it did was drop to the roll reversal. Somebody bought it. So if you got wiped out on that trade, it's not your fault. And no, I'm not going to do the how do you like them apples scene. But, anyways, it's not your fault. I know. It's not your fault. I know. It's not your fault. Anyways, it dropped, hit support. So you always have to think ahead. Where's the resistance? Okay. And did they kill yield curve control? No. Nope, they didn't. And let's just quickly look. Okay. It's not the same as it was. Yeah. So we were stuck for many, 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 many months, years, in fact, below 0.55, 0.5. Okay. So let's talk about the end of the world, right? 0.5 drop, 0.5 drop, right? 0.5 drop, drop, 0.5 drop, adjustment, and now we're 0.6. My point is it didn't go to 1. So when the yens dropped precipitously on this change, the worry was they were going to the yield would double instantly, okay? And when rates double, it attracts investment, so people would bring their yen home. So if you were Japanese and you invested in Australia, suddenly you can invest into Japan, which is less currency risk. You have to understand, if you invest overseas, you face foreign exchange risk. So now, if suddenly you can get twice what you normally get in Japan, well, you're better off investing in Japan, especially when you take out hedging costs and stuff to hedge your investment in Australia. So all of a sudden, there might be significantly more attractiveness to holding your money in yen if you're Japanese. If you're getting twice the rate, that's why the yen got strong. But it didn't double, it went up 10%, not 100%. And people are like, "Yeah, forget about it." Okay. Now, this could just slowly creep up to 1.0. But what we're learning is as we hit zero point 0.6, the Bank of Japan is already getting involved in the market. They haven't pushed it down, but they did act last night. And so we know they're not going to just let it willy-nilly go to 1%. And right? Again, that's effectively allowing rates to double in Japan. This affects the Japanese economy, Japanese companies, the bond market, the treasury market, the stock market. Okay. And them already getting involved at the higher rate already shows that they don't intend to just let it go willy-nilly, that they have not killed yield curve control, that they still want to be incredibly accommodative. They want inflation, both qualitative and quantitative, as already stated on their website. They want the Japanese stock market to continue going up, and they want the yen to be generally weak, especially, okay, and I think this is, by the way, and we haven't spoken about this. I think this is all related to what's going on in China. In China, is now forced to allow the yuan to go up in value. So if the yuan goes up, let's say, I'll make up a number. Let's say the yuan gets 5% stronger in the next couple of months. Then the Bank of Japan could allow the yen to get 4% stronger and still be relatively better off versus their biggest competitor, China. So if the yuan goes up, they can allow the yen to go up a little bit, but not too much. Maximum the 5, because then it's the same as China. And there's no competitive advantage. Just both those currencies go up slightly because they're competitors. And if Japan could just be a little bit cheaper, that benefits them. So they might just say, hey, the People's Bank of China have to allow their currency to appreciate. And if they do, we can allow ours to appreciate kind of along with it, and nobody's hurt. Huh? Except you, because now your Toyota costs more. Your Honda costs more. Your Sony TV costs a little more. Sorry. Okay. Oh, is that inflationary? Yeah. Yeah. When the two cheapest currencies on the planet start going up. Uh huh. But I thought the Fed cured us of that. I thought it was all over. It's game on, right? Maybe. But we have to think a year in advance. And, well, astute investors like ourselves try to think a year in advance, and others are surprised. I'm trying to take the guesswork and the surprise out. So, anyways, that's enough. I've gone too long. I apologize. I'm excited about a great week. Lots of news. Bank of England, non-farm payrolls. There's a bunch of other things. Lots of news out of China. The RBA. There's just a lot going on this week. Typically, it's a choppy week because of all this different news. August is usually a slow month, so be careful. Okay. And well, I'll see you tomorrow. And again, if you're watching this on YouTube, you could have been smarter 3 hours ago. Why don't you join our crew? Be here at 6:30 in the morning, huh? Peace on earth. May the pips be with you. May our profits be above average. See you tomorrow. Cheers.